Good morning, ladies and gentlemen. And we finished off another week with risk on. The risk dial is firmly in positive territory, ended the week at 42. And as we can see from the box underneath the daily model, basically it oscillated between, around 40 the whole week. The market is in a quite strong risk on phase, and I hate going short in a risk on phase. You can see it finished the previous week at 37, this week at 42, the week before that at 46, the week before that at 40. There is really no risk off to speak of, although I do think we are at very dangerous levels. If we have a look at deviations, you see that the market is actually quite close to the upper range. It is opening up, but I think we're doing one of these periods where we just crawl up towards it and then come substantially off towards the middle. You will see that the main driver of everything to me has been the XLF, which is now right up against the red lines of the 2 times. As you can see it here, this is XLF 2870. That tells me that there is very little room for the market to move up higher, while the risk below is substantially higher. Please do always have a look at XLF and these sectors. They give you very good indications of when it's not a good time to be in a particular section of the market. A couple of observations on the Blue Angels. As you can see, we are tight up against the 17 times forward earnings line. It is basically struggling, it's going sideways, there is not much of a slope. Can it go up to times 18? Yes, it can, because interest rates are so low. And if somebody can guarantee me that bonds will never cross 3% in yield, I would tell you that times 18 is still cheap. But nobody can guarantee me that, and the fact is that historically every time we have hit a times 17 line with flat slope, we have always eventually come back to the times 16 line and probably even to the times 15 line. Does that mean that the market is ready to do that now? No, it does not. It just means that the risk reward up here is very poor. Now, as we all know, it's a very big week for bonds because we have the FOMC. The 2-year will probably react most to what is said or done. And we can see how we're going into it. We are going into it very neutral. 192 on the upside is going to be the first level that the market can back up to, followed by about here we're talking about 2, and then filling this gap up to 205 or so. On the downside, we have the 175 level. Now, the market will react not so much to the 25 basis points cut that the Fed is going to undoubtedly do, but it's going to react more to the indications of what is going to happen going forward. I think the Fed is definitely not going to paint itself into a box and say, well, this is it, one insurance cut and no more. It'll say the usual stuff, that it's data dependent and that it's ready to act. But how it says it is going to be very important, because if it says that it's ready to do whatever it takes, or something to that Draghi kind of statement, you will see the 2-year note again start to lead to the downside, and people will be expecting at least another 2 cuts. Because if the data starts turning, they will cut by 50 basis points next time. I am pretty damn sure. And that will take us from 2 to 225 to 150, 175, and the market will be tight against 150 in no time whatsoever. Now the 5s and the 10s and especially the 30s will react far less than the 2-year note. You can see that really above 190 it's going to be very hard to be while waiting for the Fed. Could this be an ABC which takes us back up towards the 2, fills this gap, and 213 is really such an important level. If I change this to be a weekly chart, you will actually see how important that 213 level is in 5-year notes. And here it is. It is it's this line here. You can see how it held it on the upside and held it on the downside for a very, very good reaction. So 213, write it down, have it ingrained in your memory. If we see that yield, we really have to invest some money at 213 for a move back down. Now 161 is as far as I can see the 5-year note going, whatever the Fed says, because the 2-year has to react more and the 5-year will react less. So 161 on the downside is all I can see for the even for the foreseeable future, not just 1 week, whatever the Fed does, because it is going to take time to realize it. Now this is a chart of 10-year notes, and it is quite a bit different from 2s and 5s and even 30s. Really, we don't have very much until we fill this kind of gap at 220, and then 233, 234 is going to be a very important level. On the downside, it's very hard to see us breaking 2 and staying below it. Could you get 195 or so for sure? But really it is not. It's going to be a yield curve move rather than anything else. If I change this to be a weekly chart, again, it'll be much clearer for you. These kind of levels down here, 170, I would love to see them to go against them. It is really more likely to go towards the to stay here or go towards the 230 level. This 233 level is very important, rather than be ready to collapse all the way to 170, 169, this kind of level. The Fed would have to be very aggressive for the 10-year note to react in that way. To me, if the Fed is aggressive, the 2-year note and the shape of the curve, i.e. a steepener, is a much better bet. But I don't think that is likely to happen. I think the Fed is likely to be muted, and that is why I think XLF is likely to lag next week, simply because we're not going to have a steeper curve, and XLF really is tight up against the deviations line, and it's really done a lot. It's done 3% since we put on the position. Time to get out and take the money, basically. And on to the most frustrating chart in history, the differential between bonds and 10-year notes. 245 is the threshold, the swing, and guess where we are, minus 245. And that is probably where we're going to go into the Fed. That is why the dollar is as strong as it is, because we have the potential of a significant failure. And if we have that failure, we will probably go all the way back down to at least, what is this? This is like 258. So that's 13 basis points of outperformance, i.e. higher yields in the US compared to Europe. To me, that will definitely get the dollar below 111.08 and on its way to at least a 2 to 3% move further down. And after the yield differentials, here is the FX. You can see how important this 111.08, 09 level is. We haven't managed to close below it. We keep on testing it. We keep on failing for the time being. But if the Fed is not very aggressive, and I really do not fancy the task they have ahead of themselves, we are going to get a tightening of policy via the FX. And if they are very accommodative, they will catch criticism either way. I think the odds now become that after possibly, stopping everyone out and trading 112.40 or something like that on the Fed, we do collapse back below this 111. Those are the odds. I much prefer to, put on a short euro position above 112, between 112 and 112.40, but I don't think I'm going to have the chance. So really, I'm going to wait. I'm not going to do anything. I've not traded this very well. In fact, I've traded it quite badly. But I still believe that the Fed wants lower rates, and I still believe that the administration wants a lower dollar, because what is the point of cutting 25 basis points if 40 basis points is taken away by a tightening in the dollar? At some stage, they were going to have to be either much more aggressive or they're going to have to do something and change their US dollar policy. In the meantime, anything can happen, and I think the odds are much better now that at some stage we break below 111. If we do that, if we now change this to a weekly, you will see that it has a lot of room to come down below there, and I don't think much catches it until we go somewhere around here, which is 106. So simply because you can see how tight we have been in this in this area between 115 and 111, when it breaks, it's going to go at least 4 big figures, isn't it? I would have thought that this gap here at 107.32 is going to get filled within a couple of weeks. Switching to a DX view, it is more or less the same as the euro, not quite as aggressive. If we have a look at an enlargement of this daily, you can see that we are right up against the Bollinger Bands. To me, it's unlikely that we break through these highs of the year around 98.35 without having stopped everyone out, because we've been up, 8 days. So really a move back down towards the 97.20 is more likely, because the Fed disappoints or something like that, and then we go up. But those are minutiae. We still look like we will at some stage break this 98.30-40 area, and then I'm afraid that we do go to that level that I was looking for earlier in the year, around 101, 102. I want to start the equity review with a monthly chart of SPX, just to show you how tight we are to the top of the Bollingers, and the only time that it managed to go through the Bollingers, it had an absolute mare of reaction back down. This is very important, okay? I mean, I cannot overstate how important it is, because the risk reward at this level is that we have an absolute blast through candle and then we collapse. That is the risk reward. So the risk is much greater than the reward, and that's all that can be said about it at this level. To me, not having calls as opposed to outrights here is almost suicidal. I can almost guarantee you that even if we go up 2 or 3%, we will trade back down here at 28.70 at some stage over the course of the next couple of months. So holding for what? I'm not really sure. To me, that is an unacceptable level of risk. If we now change this to something like a weekly chart, we get much the same kind of picture. If we enlarge it, it is very unlikely that we stay even above the weeklies, and we don't come back to retest this kind of level 2850. I've been looking for 2850 for a while, but if we break there, we're going to go all the way back at least to 2900-ish. And then, my favorite level will be 2864. And in the meantime, these Bollinger Bands will have contracted, and we will be trading basically between 2800 and 2900 for weeks. And that is actually, what we will be doing is coming back from the time 17 Blue Angel, which we couldn't sustain, back to the time 16 Blue Angel. I.e., nothing much happened in the greater scheme of things, but in the short-term scheme of things, a lot happened. You will have lost 100 points looking to make another 20. To me, that is completely unacceptable in terms of risk-reward. You can see how the Bollinger Bands are coming in, and if we enlarge that on the dailies, we will see that really there isn't all that much. Let me try again, I'm sorry. There isn't all that much that we are looking for on the upside that really isn't going to be better exploited via options. Because now, if we do break this red line, and you can see how well the market has held, certainly the center line, and that comes in, okay, it'll be a little bit high, it'll be 29.95 or something Monday, and then it'll probably be 3,000 by Wednesday. If we break that, we're going straight down to the bottom of the Bollingers, 29.50. Okay, so that is your risk. The risk is 29.50 almost immediately, and your reward is another 10-20 to the upside. To me, that is an unacceptable state of affairs. Please do not be too heavy, and if you want to be, switch to options. I very quickly want to show you how well that matches up actually with NQ as well. Look how tight we are to the monthly Bollinger Bands, 80-50 it is, and every time it spikes it and comes back 3, 4, 5%. I can almost guarantee that at some stage over the next couple of months we will trade 7,500-ish. Almost guarantee it. It is so unlikely that we just bust through and stay bust. It is almost impossible. I just don't believe it. I know we're in risk on, but risk on does not prohibit a 3, 4, 5% move. Do a candle, a cup and handle type pattern and go back up. So I think being long up here and now is completely ridiculous. I don't know a worse time to have that kind of risk reward on. To me, it's much more likely that we get up just above 80-50 and collapse straight back down to 7,700-ish in the next couple of weeks, and possibly on the way down to 7,600, and then down here to 7,500 while these things rise. To me, 7,500 is the kind of 7,500, 7,600 is where the good risk reward lies. Up here, it's just awful. What happened to the DAX on the ECB day is actually very, foretelling. It just went up, 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 and then it collapsed. So this is a weekly chart. We're still closed up on the week because, after all, we are going to get easing. We're going to get more QE. Everything's brilliant. But really, it's not that wonderful in terms of market performance on what was definitely an easing and a dovish Draghi Fed. So here we have this huge candle, and what have we done? We went straight back to those moving averages which support it. much the same thing could happen in ES and especially in NQ. So really, here, what can you expect? Well, you have to be a better buyer at 12,200. And a seller, you got to do some call options for it to go down, or for it to go up. But we could easily give up, the couple of percent here, while the S&P gives up 3% or 4%. Why not? After all, we are still way below the level that we were even a month ago. So we are trading now at the same levels that we were trading in May, and have a look at where the S&P is. So the S&P could easily give up even 100 points and the DAX still be here around 12,200. VIX is getting quite interesting. I've marked the levels that I'm interested in: 1136, 1627 and 1963. So to me, 1136, if we see it, or even slightly above, great buy, just a great buy. At some stage you know that you're going to trade somewhere around the 1450 level. I would have thought that 1450 level at some stage, if not next week, the week after, on a mild disappointment to equities, tying in to what I said, that I think we will trade 2950 at some stage, is quite likely, but not much further than that. Probably something, and then I'm 1627, I think, over the course of the next month or so is possible. But not much higher than that. That is all I'm looking for, and that's why I'm saying, it's risk on. So volatility will naturally tend to be suppressed, but that doesn't mean that we can't have a quick 3% move in S&Ps at some stage to the downside, and it doesn't mean that we can't have a 200-point move to the upside in volatility. Undoubtedly, it's going to be a big week for gold as well. This is a chart, the spread chart between the S&Ps and gold. And as you can see, we have the 50 and 200-day moving averages coming down, and the market is right on top of them. And this is what markets like to do. Before big decisions, they like to go to a neutral place where the moving average is, so they can either break it hard or go with the trend much lower. So what am I saying? I'm saying that the week will end with this spread being nowhere near here. Really, it's saying that either equities are going to start going up and gold down, and then the spread is going to go towards 24 and higher, or we are going to have a continuation of this trend that happened back in June this year, when the gold started outperforming equities, and will probably break this line and go all the way down to this 2087 level, which is so important. Do I know which way it's going to go? Of course I don't, but I'm going to be keeping a very vigilant eye on this spread. Still, gold is doing absolutely nothing wrong, is it? It's very close to these very important levels and breakouts above the 1458 level. It is not retracing very much. This is a weekly chart, so you would expect this kind of consolidation below the upper Bollinger Bands. I still fancy it. If you ask me gun to head what is going to happen, I still think it's more likely that the Fed will somehow disappoint and gold will come back down to the 1360, 1370 level and give you another chance to buy it. But, will I be making bets that is going to happen? No, the risk reward definitely isn't good enough. It really isn't something that I'm comfortable doing. I would have thought that if we do see this 1370 level, is going to be an absolutely wonderful level to load up on calls. So will we see it? The jury is out. We will see what happens after the Fed, but that spread that I've just shown you, and the reason why I showed it to you, is because that is going to give us the best clue. And here are the biases. As I've told you, I've marked all the levels in 2s, 5s and 10s. TLT I haven't shown you because it's not doing very much, but 127.50 is still the level that I'm interested in, and I'm prepared to wait for it. SPX and NQ, I've shown you what I think. The risk is apparent, the reward less so. I think that is all you can say about this market. The danger of a quick 2-3% down are too high to ignore, and therefore some protection of your core positions is absolutely essential. I would not trade NQ long up here. I would much rather use NQ as a shorter. And RUT, I really don't have a clue anymore because it keeps on whipping everyone out. RUT is very financial heavy, and therefore it made sense that it should go up with XLF. I've made the money in XLF. I haven't made any money in RUT, so I'm going to leave it alone. To me, it makes sense that it remains bid. It's, because I showed you the spread the last week to where it was against the S&Ps. To me, XLF will have a red week next week, and therefore RUT is probably not a great investment next week. But I much prefer to trade it on a yield basis to SPX or NQ, i.e. as a spread rather than an outright, because it really is far too whippy for anyone to understand what the hell is going on there. VX, I've told you what I think. Those are the levels on the upside that I'll be looking for to tell me that the S&Ps have probably done enough on a dump. But that is really all I can say about that. I'm a better buyer of European equities around the 12,100, 12,200 level. Could they go all the way down to 11,700? They could, but I think it's less likely, and only if S&Ps break that 29.55 level. I've told you here, there's not a lot more to be said. 111.08, weekly close below. We're going to at least 107, if not 106, and quite quickly. Please do be careful, because I think the risk here in everything is very apparent, but the reward much less so.